when you're talking about growth stocks, the only time you really feel it is when you actually sell. I'm not saying you're not supposed to sell, but what I'm saying is this: if you believe that they're still growing, you're shortchanging yourself to sell too early only to see it go higher. And we've seen that over and over for Amazon, for Google, for Netflix, for Microsoft, for Tesla, for Facebook, and so much more. Over the past days, I posted videos about dividends. I posted the top ranking dividend stocks in the Philippines. Then I also made a video talking about US stocks and ranking their dividends out. And I got a lot of questions asking, where should the focus be? Should it be buying growth stocks or should it be buying dividend stocks? And the answer to that is, it depends on where you are, what your plan is, and what your goal is. Because at the end of the day, for those who don't know, growth stocks is you are buying companies who are expanding, who are trying to get a bigger piece of the market, or for example, they're Tesla, they're trying to manufacture more cars, they're trying to expand into different countries or territories, or when you're looking at it from an earnings perspective, you are seeing their earnings growth, their EPS grow at a very, very fast rate, that they're growing in the double-digit level. And the trade-off for that, for companies that are trying to grow, is every time they earn money, they know where to put the money. They already have a plan on where they're supposed to use it, and giving out dividends is contrary to that. Giving out dividends is somehow defeating the purpose of them trying to grow. Please do remember this, that every time a company gives out dividends, it diminishes the cash that they have that they could have used for the company to be able to expand, or for them to be able to shore up on other projects that they actually want. Essentially, companies that are growing massively, they always know that when the money is in their hands, it would be better off than giving it back to investors, because probably investors would either spend it, put it somewhere else, or it may not give them a better yield as compared when the money is still with the company. And as the money is still with the company, they have better use for it, and as they have better use for it, the company becomes more valuable, either because they start to earn more, and as they start to earn more, the stock price would follow suit based on how the company is actually growing as well. The thing about that is, normally growth stocks are relatively also more expensive, that you are buying them not just based on where they are right now, but to where they could actually be in the future. And the risky part for that is, what happens when over the next few years they don't hit their targets? Over the next few years, a competitor comes in that actually takes a piece of the pie, or whatever they projected, it doesn't actually happen the way they want it to be. Please do note that all companies, they're very, very bullish in their projects, they're very, very bullish on where it could actually be, but at the end of the day, no one has a crystal ball on how it will actually be and if those targets will actually be met. So that's the risk also when you're starting to buy growth stocks, that okay, they might be very good today, but because you are buying them at a premium, you are buying them higher. If they don't deliver on what their promise is, then you are holding on to a very, very expensive stock that you bought it at a very, very expensive price. Please do note, formula for PE ratio, price divided by earnings per share, that if they don't deliver on its earnings per share, then if you bought it higher before and their earnings per share becomes even lower, that makes the PE even higher, and that actually makes it more expensive. And that being said, if it becomes more expensive, if it's out of a certain PE range, it might also cause selling pressure, which may cause the stock also to go down again. So the trade-off there is, if they pull off and they do very, very well and they grow even higher than expected, then whatever premium you're paying for today will be warranted and you will be compensated via the increase in the stock price. And please do note that as the EPS increases, the PE ratio becomes cheaper, and for it to chase its PE ratio, the price must chase the EPS to maintain a certain PE level. Or in the same way, if the EPS is growing so fast that even if the price starts to move, the PE still becomes relatively cheap. So that will be the trade-off if you're looking at it from a growth perspective. Now, at the end of the day, if you're a person also that, okay, I'm okay to get a decent capital appreciation, but just in case it takes a while for them to continually to go up, or it takes a while before those projects also happen, or over a period of time also the movement isn't as good, you still get rewarded via dividends. So dividend investing basically are for people who want to be compensated while waiting. Whereas people who are for growth investing, they're okay not to be compensated by holding, but their main goal later is that because the company is growing so fast, I will just sell it, take profits on it, and the years that it did not do well will be compensated by accelerated growth at maybe the back end or the mid end of me trying to hold on to that stock position. Whereas for dividend investing, if it doesn't go your way, if it takes a while, you still get compensated, you still get something, you still get a relatively higher rate of return, or you still get cash flow. And then if it goes up in price, then you get the best of both worlds because you get capital appreciation and you also get dividends at the same time. And please do note, even from a Philippine perspective, we've seen that happen for A-REIT. A-REIT from the time it did its IPO, or even if you measure from its lowest point. Because if you try to look at A-REIT, it listed, but as it started to list, it dropped lower. As it started to drop lower, somewhere around 24 pesos per share, and you measure where it is right now, above the 50 mark. From a capital appreciation level, it has more than doubled already, which it has outperformed the index. It has outperformed other stocks that have been in the market for quite some time that have not been even giving dividends. So for A-REIT, you not only get capital appreciation that has doubled in price from a certain point in 2020, but you also get cash flow and you also get dividend. So I said this in a lot of videos that when I was younger, I didn't like dividend investing as much. I felt that it was relatively boring, but as I started to get older, I realized the value of getting cash flow, that it has its merit in the portfolio also, that it can do certain things that can help you. And what I was thinking even during the lockdowns of March 2020, that as long as the companies that I have, that I know will be consistent in giving dividends, at least I have a predictability of what I could actually get. I don't know how high the market will be over the next 2 years, 3 years, 4 years, 5 years, but as long as the company that I own is giving out dividends, then I could project an amount of money that will still come my way. A style that you can actually do, and it actually also makes sense that, okay, if all of your money and you're younger, you put it in dividend stocks, then you missed out on the possibility of growth. But in the same way, what you could actually do is to focus on growth stocks. As those growth stocks start to earn, you take profits on some of those positions. You can take some of them and use them to buy dividend stocks. So you could use growth stocks as a mechanism for you to earn, to be able to fund your dividend investing. And as you start to build those dividend stocks, it will give you cash flow, and that cash flow is what you could actually use to replace whatever income you have. You can take some of those earnings and buy dividend stocks, and those dividend stocks will also preserve the income that you have. So for me, they both serve a purpose in my portfolio. Growth stocks are there to give me increase. Dividend stocks are there to give me cash flow. Growth stocks are there to help me massively beat the market. Dividend stocks are there to at least give me something that's tangible on a regular basis. Because please do note this, that when you're talking about growth stocks, the only time you really feel it is when you actually sell. I'm not saying you're not supposed to sell, but what I'm saying is this: if you believe that they're still growing, you're shortchanging yourself to sell too early only to see it go higher. And we've seen that over and over for Amazon, for Google, for Netflix, for Microsoft, for Tesla, for Facebook, and so much more. So my suggestion, and I've been saying this over and over, even from the seminars that I've created, is to split your portfolio. Hello? Hello? Yes? Sige sir, salamat. Salamat sir. So your strategy is to split your portfolio. If you're younger, prioritize growth stocks. Then as you start to earn from that, transfer it to another part of your portfolio which will focus on dividend investing. To finalize everything that I said, growth if you want to maximize what you have. Dividend investing is if you want to preserve what you have. Both are amazing, both work. But again, it's not a one-size-fits-all strategy. What will work for me may not work for you, and what will work for some people may not also work for me. Try to tweak it and try to figure out what mechanism and what style will actually work for you, and what percentage of allocation will work for you. Because even for me, it's dynamic and as I get older, the premise of it, at least for my stocks, is to double down and focus on stocks that will give me passive income via dividends and via cash flow. And as I continually get older, it's nice to have a certainty. It's nice to have a regular amount of money that I know will come in via dividends. It may be boring. There may be sometimes that the capital appreciation for it may not be as fast, but that's the name of the game, that I could be focusing on other things, other passions, or I could be busy with other things, with family life as well. But because it's passive, because it's dividends, I know I could possibly get something. So if this is something that's interesting for all of you, I have a live course which is happening this March where we're going to talk about that. Dividend investing is highly connected to REITs. I'm going to talk about REITs. Passive income is also highly connected to bonds. I'm going to talk about that also. Then we also have in-between stocks where you could have a combination of growth investing and dividends. It's a masterclass for bonds, stocks, REITs, Bitcoin, altcoins, and NFTs as well. If you want to learn more about that, check it out in the description below. We're gonna have 6 sessions this March talking about it. But if you want to learn more via reading, check out the books that I have. Or if you want to learn fundamental and technical analysis, I also have recorded sessions that are part of that. We have an entire list of investment courses that I have in the description below. And if you want to trade cryptocurrencies, you want to trade US markets, we have different options for you that you can actually choose from. So what do you guys want more? Are you guys more into growth investing or dividend investing? Put it down below. And where do you want me to focus my videos on? Growth stocks or dividend stocks? I want to know your ideas, and I'm going to make more videos on top of that. So that's it for now. This is Marvingermo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you all.